Hello, and welcome to our March iteration of the SignatureFD investment webcast. We call this Cutting Through the Noise. Now, as a reminder, we're going to stick around and answer questions that you might have after our prepared remarks. So if you have a question, please feel free to submit it through the questions section of your meeting. Now, I'm Tony Welch, Chief Investment Officer here at SignatureFD. And for those new to our firm, just a quick little bit about us. We are a registered investment advisor established in Atlanta in 1997. And we also have a location in Charlotte. We're 100% independently owned, and we're entrusted with over $6 billion of our clients' assets. Now, if you want to learn more about how we help to integrate investments in your financial design, you can visit our website and try out the blueprint here to get going. All right, so we did spend some time last week covering the banking issues. We did that in some detail last Tuesday, and we've been keeping a running Q&A as well that is available for clients. So if you want access to either of those things, just message your advisor or email me directly, and we can get those over to you. Now, as for some of the other things that we're watching this month, leading indicators of future economic growth have been signaling a likely recession, but they've had that message for some time now. And when we look at real-time indicators, those suggest that the economy still has some momentum to it. And that's largely due to a still robust savings pool and a tight job market. Now, finally, the trajectory of inflation through the duration of this year, that's likely to impact the markets. So we're going to spend some time on what we see there. So let's start with a 30,000-foot view. The Atlanta Fed tracks incoming economic data to come up with a real-time estimate for inflation-adjusted economic growth. And what we're showing here is the estimate for the annualized Q1 rate of real growth. And as of about a week ago, it was 3.2%. And that's actually pretty strong. And it's been rising despite the issues in the banking sector. So one thing to keep in mind here is that our economy is about 70% consumer driven, and spending has remained strong. So how have these consumers been able to keep spending despite the inflationary pressures, particularly the pressures we saw in the first half of 2022? So this chart on the left shows the number of job openings per every unemployed person in light green. And it's currently at about 1.7. And that means that for anyone that may want a job, they have almost 2 jobs available to them. Now, this is an overly simplistic way of describing the situation, but directionally, it does do a good job of illustrating that the job market does remain tight. Now, the chart on the right shows the explosion in savings due to pandemic stimulus, and note that it's begun to start to get drawn down. So consumers gained about $2.4 trillion in savings, and they've spent down about $1 trillion of that. And that means that there's about $1.4 trillion left. Now, if they continue to dissave at the same rate that they have been, they wouldn't even run out of excess stimulus savings until late in 2024. So we're going to talk about some other concepts as we move forward today, but I would keep this in mind, and we shouldn't underestimate these forces that are keeping consumption robust. Now, the other evident factor at play is that consumers are playing catch up right now. They're playing catch up on their travel, leisure, dining out, medical care, really all those services that they were missing out on in the height of the pandemic. Now, this chart here, it shows the different categories of goods and services and their percent of total consumer expenditures. Now, there's been a steady uptrend in red here. The line in red is what we're showing is spending on services. And there's been a steady uptrend in spending on services through time. Now, note that service spending as a percent of total spending remains below its trend, but it has turned higher of late. In other words, this is just another way of showing that people are out there spending on services spending on those things that they've been missing out on. And anyone that's been to a major airport lately would probably agree with that assessment. So it's by and large a good thing that we're back vacationing again and we're seeing our doctors, but this has been an issue for the Fed in their fight to bring inflation lower. So this is an interesting chart that breaks down inflation into a few components. It breaks it down into sticky and flexible inflation. Now, you can think of those flexible components as those goods that we were buying in the middle of the pandemic. This is the stuff that was hugely influenced by the supply chain issues of 2021. Now, sticky inflation is more of those service-oriented categories. So what we've seen here is that core flexible inflation is actually declining, it's deflating year over year. But the sticky inflation component is still trending higher. And actually, airfare, which was one of the highest inflationary components to last month's inflation data, that's one of those so-called sticky components in the inflation calculation. Now, a big part, an even bigger part than the travel and leisure stuff, a big part of that sticky inflation is housing related. And rents are still trending higher. And that makes sense given that there's lag in when rental agreements turn over from year to year. And they're also calculated in a smoothed out fashion in the inflation numbers. So here in this chart, what we're showing in red, that's the inflation category that's called owner's equivalent rent. And we can see that it's still moving up and it hasn't rolled over yet. But home prices have already begun moderating. And in fact, just yesterday, we got an update on median existing home sales price, and that contracted year over year from this time last year, and it's the first yearly decline since 2012. So we're reasonably confident that housing-related inflation will follow these real-time trends in the housing market and move lower as well as the year progresses. So that begs the question, has the Fed done enough, or have they done basically all they can do? And we're going to get a Fed policy decision here today at 2, and we'll probably have more to say on that after we see the presser. But we need to remember that the Fed, they can't spend down the pandemic stimulus any faster, or they can't force companies to stop hiring. What they can do is they can tighten lending markets, which they have clearly done, as evidenced by the recent banking failures. And the bond market seems to think that the Fed has tightened about as much as they can. Now, before the news on Silicon Valley Bank, the market was pricing in a Fed rate above 5.5%, and they were of the belief that the Fed was going to hold that rate at that level throughout the duration of the year. Now, after the turmoil we saw in the banking sector, they changed their assessment to, and this is market-based assessments, not the Fed, but the market changed its assessment to one more hike today and then cuts beginning in the summer. Now, we think that the market is maybe pricing in cuts a little too aggressively here, but it is reasonable to expect a pause in the hiking cycle. And that sudden change to market pricing on Fed expectations, that makes a lot of sense when we consider the role of banks in the economy, especially the smaller banks in lending activity. Now, this chart here shows the percent of bank loans in different categories broken down by banks with less than 250 billion in assets, and then the larger banks. And what we can see is that the smaller banks are a significant source of capital for businesses, consumers, and real estate, both on the commercial and the residential side. Now, it does look to us like the regulatory bodies have seemingly done enough for now to stem the immediate banking issues. But over the longer term, we suspect that lending standards are going to continue to tighten. Now, here in this chart, we're showing that lending standards had already tightened heading into the turmoil, and loan demand had already been falling. So all else equal, this would likely result in a significant slowing of economic growth. But remember, this isn't happening in a vacuum. This is happening amid a backdrop of a very strong consumer. So we do suspect that a recession is not necessarily in the cards of yet. But the main message that we would take away here is that economic growth is probably reaching a crescendo in the first quarter and is likely to slow from here. Now, eventually, that should funnel through to employment, which would result in an official economic contraction. So here in red, we're showing small business hiring plans, and that data series is inverted. So what it's telling us is that small businesses are slowing down in their pace of planned hiring. And this series tends to have a leading relationship with the unemployment rate. So today, the unemployment rate is 3.6%. And this indicator here suggests that based on small business plans alone, the unemployment rate should actually be a bit higher already. But again, this cycle does have some unique characteristics to it. All right, so that's a little bit on the macro backdrop, but let's get into what it means for investing and investments at large. So here in this chart, this is some interesting work from our friends at Ned Davis Research. In the top, they're just showing the return for the S&P 500 index, and that's including both price appreciation and reinvested dividends. Now in the bottom in orange, they plot economic growth relative to potential economic growth. So high readings here mean that the economy is running hot, and negative readings mean that the economy is running cold. Now the dashed black line is inflation relative to its average of the last 5 years. And we can break that growth and inflation mix up into some overall regimes. And that's what the statistics in the box here are telling us. So let's zoom in on that. Note that we spent much of the last year in this zone here that they would label stagflation. In other words, inflation was high and growth was weak. Also note that that is the only mix in which stocks have averaged negative total returns. So where do we think we're heading? That's really the important question. We've been in that zone. Where are we going from here? Well, we think inflation is going to continue to improve. So we're either heading into one of two places. We're heading into a slow growth, low inflation environment or a recession. Now note what's interesting here, that either one of those mixes has been a vast improvement for the average annual return in stocks. Now, what about for bonds? What's the potential playbook there? So this chart applies that same analysis to long-term bonds relative to short-term bonds. So let's zoom in here and see what the data has to say. So for bonds, it's sort of interesting. In a stagflationary mix, essentially cash is king. Short-term bonds tend to outperform long-term bonds, and that's exactly what happened in 2022. But for bonds, inflation is really an important component here in the economic trajectory. For bonds, if inflation improves and economic growth remains positive, that's not necessarily an environment where long-term bonds perform better than short-term bonds. Where longer-term bonds really shine is as a hedge in the recessionary scenario. So we'll have more to think about in our bond allocations as we continue to get data on the economy. Now, within the stock market, we're currently taking a very neutral approach. So how are we positioned in the stock portfolio? And I'd characterize it as very neutral. We're not really favoring any sort of sector over any other sectors or any sort of style over another style. And though it feels like there's always something to be done, we prefer to take an approach whereby there's only something to do when we can have really high conviction. Operating on a higher frequency than that tends to result in portfolio churn and really bad outcomes from both a performance and a tax perspective. So today, we don't really have a high conviction view right now. And that's because we're not really getting paid to make a major bet. So this chart here is an interesting concept from our friends at Empirical Research. It shows the difference in valuation between the cheapest names in the market and the most expensive names in the market. Today, that dispersion in values, that's about at its historical average. So what exactly does that mean? Well, when the cheap stuff is exceedingly cheap relative to the most expensive stuff, that tends to be a really good time to lean into value and a value approach to investing and buy cheap stocks, sectors, and markets. Now, on the flip side, when there isn't much difference between the cheapest and most expensive stuff, you tend to be rewarded for buying more growth-oriented companies. So today, the market isn't really giving us the green light on either one of those investing styles over another. Now, one other really interesting note on this point is we can break out those differences in valuation by sector. So this chart goes sector by sector, and it compares the cheapest stocks to the most expensive stocks within the sectors themselves. So in times of true market panic, you would normally see huge valuation differences broadly across all sectors. And we do see that in financials. The banks are trading at much lower valuations than other subsectors within financials. And we also see it in REITs, where office REITs continue to come under pressure. But I wouldn't say that our interpretation here, that it's not broadly in line with some form of a 2008 style contagion event. Okay, so to recap what we went over today, the economy does seem to be carrying some positive momentum, and that's largely driven by a catch-up in services spending. That catch-up is creating some lingering inflation pressure, but we do expect shelter, which is a big part of that, to roll over, and that would help bring inflation down as the year progresses. Regardless, we think that growth will moderate in upcoming quarters, and it's the improvement in inflation that may dictate where we take an investment strategy from here. Now, a final word on the banks. Stress is not yet blown out to a wide array of sectors. That said, we're not necessarily being rewarded to make any major bets in the stock portfolio right now. Taking a balanced approach remains warranted for now. Okay, so that's what we have as far as prepared remarks go for today. So let's see if there's any open questions. Okay, guys, well, we don't have any further questions for today. As always, thank you for giving us the time and tuning in. And we will continue to fill you in with our latest and greatest thoughts. Thank you.